please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good afternoon. Welcome to Halftime Report. 12 noon, halfway through the trading session, and markets today have opened up at record levels. Saw a bit of profit taking, as you could see, about an hour and a half into trade. But now as we speak, the dip has been bought into and the Nifty is hovering around that 11,400 mark, crossing it for the first time ever. It's Bank Nifty, which is clearly taking the pole position today. So the Bank Nifty is higher by close to about 1%. Let's get the show kick-started then with all the top stories. Get the show kick-started, let me introduce my co-anchor, Lata Venkatesh. Lata, pretty good start to the week.
Oh, yes. Thank you for the introduction to me and the markets. But I'm just sitting in for Prashant Nair. We should be having him very soon on the channel, on the show. Yes, actually, the market started with a bang. And then they've actually been dilly-dallying between these 11,400 and 11,425 thereabouts. Not made, you know, if you bought at the beginning, gap up, you're not making money, and that's not very positive for the bulls. So unless you're able to beat the opening market high, the initiative could well pass on to the bears, at least for the moment, or at least you would see a bout of profit taking. So we have to watch the European opening and the performance of the Indian market very closely post midday. The story is diametrically different for the Nifty Bank. There you are at the highest point of the day, though even though you may not have made too much money, having bought at the dips, you're still in the money. So quite clearly, it is the bank that's leading the bull by the horns.
Okay, let's then start the show with our corporates. HPL Electric and Power is buzzing in trade this morning despite reporting a tepid first quarter. The gross margins were flat on a year-on-year basis, while finance costs have risen. Gautam Seth, the Joint Managing Director of the company, joins us on the phone line. Good morning, good afternoon, Gautam, and thanks so much for joining in.
Yeah, good afternoon.
Yeah, if you could first start off by talking about your finance costs. That has gone up by 16% on a year-on-year basis. What is the current debt on the books and what led to this higher finance cost?
Yeah, our higher finance cost has gone up mainly on two reasons. One being that the RBI has discontinued the LOUs, which is the buyer credit, and so therefore the debt has gone up on the books, which was earlier coming into the creditors. So in a way, what was coming in the creditors now gets substituted into the debt, and so that's how the borrowing appears to be on a higher side, and also a little bit on the finance cost actually going up. So our net borrowing is currently at 449 crores, which has gone up almost by 39 crores since the last quarter, and it's mainly due to this reason.
Okay. The RBI has only banned LOUs. You can still manage with LCs, can't you?
Yeah, we are currently using LCs for our imports, and at the time when the Reserve Bank of India banned the LOUs, we were having certain outstanding positions, which, as I said, got substituted from the creditors to the borrowings, okay. And that led to a certain increase in the overall debtors when you see. However, there has been a reduction in the sundry creditors of over 90 crores coming in during that period. Okay.
When do you think the entire impact will be off the books?
No, what we are currently working is that if you see overall we are working on a working capital improvement, and in fact if you see on the sundry debtors, we have been able to reduce our sundry debtors quite considerably, and in fact 21 days we have reduced only in the last quarter, and overall our sundry debtors, which were around 180 days a few quarters back, came down to 164, and now it's on 144 days based on net sales. And the company has been working on channel financing and trying to improve the trade debtors, and that has shown good results to us. And on a gross sales basis, that has come to 95 days, which was earlier 130 days. So we have been able to improve our working capital cycles more on the debtor side. Now we have taken another target to reduce our inventories also, and by 31st March, we expect those inventories to be at 400 crores.
Okay.
With our sales going up. So that would again bring in a much better working capital efficiency, and therefore the impact should be
okay. Gautam, we don't have too much time, so quickly, if you can tell us about metering. That is half your business, and that has grown only by 3%. Why was it so bad? Do you expect it to improve?
Our deliveries in the first quarter have been more or less on schedule, but the schedules are set to pick up from the second and the third quarter. We've been witnessing a very good amount of growth in the meters in terms of order book. That our order book right now is over 456 crores after having at least 2 or 3 quarters where the execution has been much better than before. So going forward, we do expect a high 2-digit growth in the current year, because already we are sitting on a good order book. Moreover, if you see the order book, a lot of orders have come since our last results, which were on the May 20th. And we have been, so there's a constant growth in terms of orders, and we do expect in the next 2 quarters a good amount of sales coming in from there.
Okay, right, and Mahindra Life. Now, that stock has taken a big hit in today's trade, down 7.5%. Shares worth 135 crore or 5.1% equity changed hands via block deals today. So that's put pressure on the stock today. On the flip side, JP Group stocks are higher. So JP Power, which has reported a profit this quarter compared to losses in the prior quarters. So that surged close to about 17%. Of course, it's a 3-4 rupee stock, but JP Power is in focus. And you can also see some green on a couple of the other JP Group names. Hi, Prashant.
Rima, hi. So I think the only thing worth talking about today in a way is HDFC, right?
Yeah.
HDFC AMC. I mean, that one was expected to have a big day, and it's not disappointed in that sense. Otherwise, I mean, it's actually a pretty good start to the week. 42 odd points or so is what we have on the Nifty. 1340 stocks are higher, 750 stocks are lower. So it looks like another smooth week, at least a smooth start to a new week. Almost identical to the one that we had the last week. Although midweek, last one we had some turbulence, but Friday to Friday we managed a pretty decent kind of close. 200 on the Sensex is what we have. Okay, here's an important soundbite, and this is an exclusive. The DEA Secretary Subhash Chandra Garg says that the fiscal deficit for FY18 won't cross what they targeted, penciled in. Speaking exclusively to Sapna Das, he also talks about the impact of MSP and Ayushman Bharat schemes on the fiscal situation. Listen in.
The government has actually adopted the principle of giving 50% cost plus prices. The MSP, as far as the fiscal impact is concerned, you make procurement for the Kharif crops in October, November, then those get sold much later in January, February, or even later in March, April. The fiscal impact is only at a time when there is a sale at a loss, right? So the fiscal impact of in the current year of the MSP is hardly anything material. We have already a major provision in food subsidies, which are there. So
1.60 lakh crore
1.6 to 1.8 lakh crores, getting 5-10,000 crores here and there for that is not too drastic. On the Ayushman Bharat, I think things have become much more clearer.
Okay, moving on to the stock of the day, and that's HDFC AMC. It's a strong debut for this one. It's listed at a 60% premium, much higher than expectations. The grey market premium was close to about 40%. So compared to that, it's now higher by 65%, crossing that 1800 mark. Abhishek is here with the key details. Abhishek, the valuation now is nearly double than that of, say, Reliance Nippon AMC after this kind of an up move and run up.
Well, let's not talk about valuations for HDFC group of companies. They never are under industry levels at any company that you see. So it's the strongest listing of 2018, the 5th company from the HDFC group to come out and get listed. It is the 16th largest company amongst the BFSI units in terms of market cap, and it is the 8th largest NBFC in terms of market cap. So if you look at the valuation parameter, what the analysts use is market cap as a percentage percentage of AUM. At the IPO, it was priced at 7.6. It listed at 11.9 and it touched a high of 12.6. Currently, the valuations are about 12% of the market cap. They are the second largest AMC, with ICICI Pru being the largest AMC. Their strength is that they have an excellent distribution channel. Persistency ratios are higher. They are the most profitable AMC and market leader in balanced fund with 35% market share. However, the weakness is that they are losing market share. And the market share loss is coinciding with the fact that many of their schemes are underperforming, and that is leading to moderate PAT growth in terms of what their AUM is growing. So their core earnings are lower due to higher share of treasury investment as a percentage of their net worth. Back to you.
All right. Thank you, Abhishek, for that. Yes, it's like sky-high valuations for HDFC AMC at 12 times trailing versus Reliance Nippon AMC, which is close to about 6.5 to 7 times, so nearly double. But let's get to the man of the moment then. CNBC TV18's Yash Jain caught up with Milind Barve, the MD of HDFC AMC, and began by asking him the amount raised through the IPO and whether they need more funds in the short to medium term. Listen in. Short to medium term. Listen in.
The issue was for about roughly 12% of the company's capital. It was entirely an offer for sale by the two shareholders. In terms at the offer price or the upper end of the band that was announced, the issue was amounting to about 2,800 crores. Okay. And if you, there were reservations for shareholders of HDFC Limited and the usual reservations for employees of HDFC Limited and AMC. If you keep the reservations aside, then the issue was open for about 2,400 crores. Right. So it was a 2,400 crore public issue, 2,800 crore total issue, all offer for sale, amounting to approximately 12% of the company's paid-up capital. Okay. And basically the sale was made by HDFC Limited and Standard Life Investments, the two shareholders.
But at HDFC Life AMC, would you be getting any part of those funds, or are you in requirement of funds in short to medium term?
No, as I said, this was a full offer for sale, so there is no part of the IPO where funds come into the AMC. The business does not need capital. In fact, the business has a very high return on weighted average net worth as such. Right. And actually it keeps throwing free cash based on the profits we make. So it's not a business that needs further capital. In fact, the minimum capital requirement is as low as 50 crores, while what we have in terms of net worth is upwards of 2,000 crores.
Absolutely. As far as the Indian shareholder, HDFC, is concerned, of course, you'll also have to follow the minimum public shareholding norm of 25%. Is there any floor or any point to which HDFC would want to maintain its stake in HDFC Life AMC too?
Right. So actually, this company was a 60-40 joint venture between HDFC and Standard Life Investments. Before the IPO, there has been a shareholders agreement by which it was agreed that finally, when we achieve the 25% dilution, which we are required to over 3 years' time, HDFC will own eventually 50 plus 0.01, right, and Standard Life will have 24.99%, okay, and 25% will be with the public. So the final shareholding pattern that will emerge after 3 years, when we achieve the full 25% free float, right, will be 50.01, 24.99 and 25% with the public.
Okay. To speak about your financials and to start with the assets under management which you have at this point of time, what is the kind of growth which you've seen in the last 3 to 5 years in terms of your AUM growth? And as we go forward, looking at the growth and the translation of household savings into financial savings, what's the kind of growth which you expect in your AUM going forward in the next 3 to 5 years?
So the past few years, the industry has seen very strong growth, and this has come on the back of retail investors participating in mutual funds in a meaningfully different level. Right. There used to be a time when people like us may have been in this industry for many years now, and if we collected 15 or 17, 18,000 crores in a year, we used to think this was a reasonably good year. Right. And now we collect 11, 12, 14,000 crores per month. If you go by what has been sort of seen the run rate in the last few months. So I think the industry has gone to a new level of growth, and I think we have been as much a part of the beneficiaries of that growth. We have the largest, we are the second largest in total assets under management, but more importantly, we are the largest in equity assets under management. Exactly. And that's really been the strength of this company. Apart from the fact that we are very focused on retail business. More than 62% of our total AUM comes from retail assets. And if you go by some of the data which is available to us, we are amongst the largest retail manager of assets in India.
Because you've spoken about your retail book out of the total AUM, 62% versus industry average of about 50%. How does having a larger share of retail book help the company?
So the retail investor really chooses more equity-oriented products. So the product that retail investors buy, and in my opinion should buy, is more of equity-oriented products. It is a business which people invest for a much longer period, so the persistency of the business is much longer. It just stays with the asset management company much longer than, say, debt funds or short-term funds. And most importantly, equity funds which come from the retail investors provide the asset manager with a better margin. So I think in that sense, it's a win-win for the retail investor. He gets a better product which is more long-term oriented. You can stay invested for a long period of time and enjoy the sort of the power of compounding. And for the asset management company, you get more high-quality equity-oriented business which has better margins.
Okay. Speaking about your profitability, in FY18, you showed a growth of about in excess of 30%, 31% about, which is individually doubled in the last 3 years, FY15, FY16, FY17, right? It's double. In that sense, help me understand, is that kind of profit growth consistent in your sense? Do you think you can continue a profit growth of over 30% going forward?
No, it is not appropriate to talk about future trends in profitability, but clearly last year was an exceptionally good year for the industry. We benefited from that. We had a reasonably good market share in the growth that the industry witnessed last year. The last year's flows were to some extent definitely aided by the demonetization which happened just around the period which began with the last year. So I think in last year's flows in the industry were of the order of about 240,000 crores in the industry, which would give an average run rate of 20,000 crores. Right now the industry's run rate in the first quarter has been in the order of 10, 12, 14,000 crores. So I wouldn't use the last year as a basis for the future. But I think, as I said, we are in a completely different zone in terms of flows into industry. And as one of the large players, particularly managing more equity business, we hope to benefit from that.
So you think that the last year, maybe the growth in terms of profitability could have peaked? Is that what you're trying to tell me?
It is difficult to predict profits. I mean, that's not something that we would like to do today at this stage, and we are not providing any guidance on profits. I think we have a good profitable model that in the business, which is more important, and that model comes from a superior product mix and managing costs very deftly. So we have very low operating cost expenses as a percentage of the overall AUM, and therefore the most important number in an asset management company is the operating profit margin. And I think we have a reasonably strong and leading operating profit margin in the business, and we think that should help us.
Okay. Talking about the return ratios, very impressive again, ROAs in excess of 40%. Again, the same question, do you see sustainability in these return ratios as far as both the aspects are concerned?
So the return ratios will always be a function of how much profits we make, firstly, and obviously how much of that profit we are either able to distribute, like to distribute or retain in the business. So I guess I can't prejudge what the board will decide in the future, but the trend of dividend payout in the last few years has been increasing on that every year. So we had dividend payout of 41%, went to 47%, went up to 51% and 56% last year. So I would expect that the board will be hard-pressed to take a view on dividend payout ratio, which will keep the return on equity at a reasonably high level.
Okay. You've also cued me to my next question, which is, of course, the dividend policy. An average dividend of about 41% in the last 4 to 5 years. Something that investors would certainly want to know. Would you be able to continue as far as an impressive and aggressive dividend policy is concerned of similar kind going forward?
As I said, I can't prejudge what the board will decide in the future, but we have been consistently increasing the dividend payout ratio every year. And last year is 56%, which is we have paid out more than half of the year's profit in the form of dividend. So I can only hope that the board will be mindful of the fact that we need to keep investor aspirations in mind and keep a reasonably high return on average net worth.
Right. As far as your understanding on the inorganic growth front is concerned, you've taken that route twice since the time you started your operations, be it in the form of Morgan Stanley Mutual Fund, or be it in the form of Zurich India Mutual Fund. At this point of time, do you remain open? Are you on the lookout for more such acquisitions in terms of increasing your asset base going forward?
I think we are always open. Does it mean that we are overly keen to go out and look every day at what is there to acquire? Probably not.
Okay.
For us, the acquisition decision is based on whether there is a synergy into what we look to acquire. Does it add something that we probably cannot do in terms of timing of what we can add to assets? And most important, what it does to our return ratios. So obviously, an acquisition is useful or attractive for what you get for when you acquire and what price you pay.
Right.
And I think these will be the two guiding principles of any decision that we will make on acquiring new businesses. Right. So we will